It means that the Chinese stock market can grow 140 times from now. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective and local insights about investing in Chinese stocks as well as in personal finance. Today I want to talk about why you should or should not invest in Chinese stocks now. First of all, you will get a much higher return in the long term compared with investing in the US or in other developed markets like in Europe. So when you think about China, you think about the most populous countries in the world, right? With 1.4 billion people, and also all your sneakers, your mobile phones, and your plastic bucket, they're all made in China, literally everything. Just look at the economy. The Chinese economy grew from 294 billion US dollars in 1978 when the country opens up for business to $11.52 trillion in 2019. So the GDP of China grew 39 times in around 40 years. Compared with the US, it grew around 3.9 times during this 40-year period. So you can see Chinese grew 13 times faster than the US in the past 4 decades. Okay, but that was in the past, right? How about the growth potential? So if we look at GDP per capita, China is around 8,000 in 2019, and in the US it's 56,000 per year. It means that in order for China to catch up the same level of income per person like the US in 2019, China can go up 7 times. That's pretty impressive. It's clear that China has been growing much faster than the developed world and is likely to do so in the coming years. So does it translate to the stock market then? This is the important point, right? So that's the reason why Ray Dalio thinks that we should invest in China now, of course. Let's have a look at the stock price when the US GDP per capita was $8,000, which is the level that China has in 2019. Oh, well, hold on. World Bank only actually has comparable data back to 1960. And interestingly, in 1960, the number for the US was $17.5 thousand per year. That's roughly twice the number that the Chinese have in 2019. Okay, so let's use this as the anchor point and start. So in 1960, the S&P 500 was around 60 points on average. Today, this S&P 500 is 4,188 points. So of course in 1960, the GDP per capita is actually twice as high as China in 2019. So we make the broad assumption that the S&P 500 would be halved in order to reach the GDP per capita of $8,000 per year. So 30 points comparing with 4,188 points. So if the average Chinese citizens were to get as rich as the US citizens today, and the stock market grew as fast as the US stock market in the past few decades, it means that the Chinese stock market can grow 140 times from now in the coming decades. In the long term, there's little doubt that investing in the Chinese stock market would bring us more return than investing in the US or other developed countries in the coming few years. Another important point is that China is the only country in which you would find the highest concentration of the biggest companies in the world which you have never heard of. Yes, and there's modern tech companies like Alibaba. Well, for example, if you want to repeat the success of Tencent, which owns WeChat, WeChat Pay, Weibo, many fintech companies and gaming companies. So by the way, we are talking about the scale of 1.2 billion monthly active users on WeChat, so one app alone in Tencent. Yes, it's billion, not million. So the stock price of Tencent went up almost 1,000 times at its peak since it has been listed on Hong Kong Stock Exchange in 2004. Well, I wish that I bought it in 2004 as well because I started my investment journey in 2002. So do you want to repeat the success story of Tencent? There's plenty to choose from actually. For example, China has the largest high-speed railway network in the world. And it was built only since 2007, in 14 years' time. The companies that build and operate the railway are very often listed. For example, China Railway, China Railway Construction, China Railway Rolling Stocks. All of these companies are listed on Hong Kong Stock Exchange. And foreign nationals are free to trade stocks on Hong Kong Stock Exchange. And most of these companies are available on e-brokers. For example, in the US, in UK, and Germany. By the way, if you are still using traditional banks or traditional brokers for stock trading, check out my video here, comparing the costs of trading with traditional banks or brokers versus e-brokers. On the other hand, China is also leading the world in terms of renewable energy and electric vehicles. You probably heard about NIO or BYD, this kind of companies, but there's actually much more, which I will cover in separate videos. In short, China is the only country with such a high concentration of the biggest companies in the world with such high growth rate, so we should not miss out. Then why not many Americans or foreign nationals are buying directly into Chinese stocks? Well, first of all, they thought that they do not have access to it. It is true that on mainland China, like Shenzhen or Shanghai, those stock markets are basically not open for foreign nationals. However, you can buy through Hong Kong or some ADRs in the US. They are widely available on online brokers or even on some traditional brokers. For example, Interactive Brokers, Charles Schwab, Fidelity, etc. And more importantly, I think is that people lack the insights into what to buy and what are the risks. So that's why I'm here. So if you want to get more insights into investing in Chinese stocks, smash the subscribe button now. Remember to click on the bell button so that you will get the latest news about Chinese stock from me. Okay, so is it all rosy and shiny? Of course, there's always a downside. I think the first downside I could think of is the share price fluctuates a lot, especially in A-share in mainland China. There are reasons behind. For example, 97% of the investors on A-share are actually retail investors. And in comparison, if you look at the US, more than 60% of the volume of the trade are by institutional investors. So you can imagine that institutional investors are more long-term compared with retail investors. So that's why some people say that A-share in mainland China is basically a casino. Secondly is the political tension between China and the US. If you remember, in the past few months, a number of Chinese companies were being sanctioned and some of them were being delisted from NYSE or NASDAQ. That's why I always say that it's better that you invest directly into Chinese stocks rather than investing in ADRs listed in the US. After all, foreign nationals are free to buy stocks and sell stocks in Hong Kong Stock Exchange. Last but not least, government policies and politics. Do not need to look too far. A few months ago, Ant Financial, a subsidiary of Alibaba, were planning to do an IPO in Hong Kong. It was supposed to be the largest IPO in the whole year in the world. But guess what? Literally 1 or 2 days before the actual listing, it was being called off by the Chinese government. That's why we always need local insights to understand how Chinese politics work. In summary, given that the people in China is getting richer and richer, and the stock market is extremely likely to go up as well, similar to what happened in the US, there's a huge upside potential to invest now. They have the highest concentration of some of the biggest companies in the world with the highest growth rate. The downside, of course, is that the different market behaviors, like the retail investors in China, and also there's uncertainties about the tension between the US and China, and of course, the differences in terms of how government policies are being formulated, and the very different kind of politics. But this can all be mitigated by having better local insights on China. For me, it is a sure win to invest in China now for the long term comparing with just investing in developed markets like Europe or the US. What do you think about it? Give me some comments here below. If you like the video, remember to like and smash the subscribe button. Even better if you click on the bell ring so that every time if I have new videos, you will be informed. This will be great encouragement for me to make better and more videos about Chinese stocks and personal finance.